A huge honor to have on the show today James Lavish. Welcome aboard to Bitcoin People.
Well, thank you for having me, Carrie. I am sorry I'm late. My other meetings held on longer than I thought, so I appreciate your patience. So thank you for having me.
Crazy day, crazy times in your life. Thank you for being here, and our listeners are none the wiser. I'm really tempted to say here's a man who needs no introduction. But for those who may not know you, and I'm always living in hope that I've got someone on the program for whom this might be their first exposure to Bitcoin. Maybe this is the first literally podcast they've ever heard anything about Bitcoin. So, James, please, would you mind giving a little bit of background about you, your a little potted history on your personal and professional life, if you wouldn't mind?
Sure, absolutely. So, as some of your listeners may know, I've been an institutional investor for a long time, for almost 30 years. I hate to put an age tag on me, but it's been I've been in that hedge fund and private equity space for quite a long time. And so yeah, I've recently come over to the Bitcoin space. Recently, meaning I'm not an OG. I haven't been around since 2011 or 2013, buying it at pennies on the dollar. But I got into Bitcoin in 2020. It's a little bit of a circuitous story, but as an institutional investor, well, I'll back up. So as you know, and some of your listeners may know, in college, in high school and college, I was a hockey player. I was an ice hockey player, and so that's what I was going to do. I was definitely going to get an education, and I ended up playing for the Yale hockey team out here in the States. And so I was getting an education. That was good, because I always needed my backup plan.
Mm-hmm.
But as it works, as it happens, I was drafted by the Boston Bruins back in 1989. And so that's where I thought I was headed. And as it happens, that's not where I was headed, because in my senior year, when we were negotiating out my contract with Boston, I took one bad hit. It blew out my knee, and it basically ended my career. So
That must have been devastating. Does it,
oh,
does it happen a lot? And I can imagine it happening a lot in hockey.
yeah, funny enough, there were some players around me who got hurt, and it knocked them down. But mine was it was the kind of injury that my style of play really impacted negatively. And what I mean by that is, one of my greatest strength easily was my speed. And so I was so fast on the ice, and I used that strength. And that was quite honestly, that's what gave me the edge. I had just an extra gear, and when I got hurt, I lost that gear. And so I was just yet another, pretty good college player without the speed. And so you can't just be a pretty good college player if you're going to be a pretty good, NCAA player if you're going to get to the NHL. So
Mhm.
was it devastating? Yeah, I lost my identity, completely lost it. I thought this is who I am. This is who I'm going to be. I projected all these, these visions and these thoughts in the NHL and, stardom. And, but that wasn't even the thing that hurt the most, to be honest. The thing that hurt the most was, I grew up in upstate New York, and in a little town near Saratoga, and about 2 hours away from Lake Placid. Well, if you remember, back in 1980, the U.S. Olympic hockey team played the Russians in Lake Placid to win the Olympics, and that's when we won the Olympics back in the Miracle on Ice in 1980. And I was a 10-year-old boy watching that. I wasn't at that game. I did see them play Sweden. We were all the way up in the rafters. My parents didn't have money. So, but I did get to see them tie Sweden, and that was exciting. But yeah, and so ever since that point, my biggest goal in life, I was 18 years
Mm.
old, but my biggest goal in life was to, that's all I was working toward, is just studying and playing hockey, and I want to be on the Olympic team. Well, the sad part was I was on the national team. My coach was going to coach the Olympic team, my college coach. and I was on the national team, and I was, one of the last few players cut. And it's simply, I mean, there's no way I was going to make that team with my injury. And so that's the part that was really devastating. When I look back, I don't have dreams of being in the NHL. I still have dreams because I've got to wear the USA jersey a couple of times, and on the national team, and I have dreams about that. And so that's probably the part that hurts the most, I would say. So, but yeah, I lost my identity. I had to start
Lost your
over.
identity, as you would. And that's hard to take, particularly as a younger person, I reckon. Oh, maybe
Yeah,
at a stage of life, I don't know. What was the process of making your way from there then? You had your backup plan, you had your, you did political science, and you also became a CFA.
yeah.
Which direction what was the idea in terms of the backup plan where you thought you might head towards if hockey didn't work out?
So my backup plan, if hockey didn't work out, I never thought about getting injured. I just thought that
Mm,
maybe I wouldn't be good enough, that I
right.
wouldn't want to be, knocking around the minors for years and years. If I had a Yale education, I wanted to do something. Well, I got a political science degree because my backup plan was go to law school, become a lawyer in
Ah,
order to become an FBI agent. So I thought that I was going to go to the FBI. That was my backup plan. And then I blow out my knee, and you have some major physical tests if you want to be a field agent. And so I was like, well, I can't do that now.
no.
So yeah, so I went to New York. Here's the funny thing is, I'm not sure I've ever told this story before on a podcast. I went to New York. It was 1993, 1990, the fall of 1993, and I just realized that there was no way I was going to make it. I had been traded to the Rangers for a puck bag, an old puck bag, and you know, but so I'm trying out the New York Rangers, and they go and win the Stanley Cup without me because I wasn't going to make it. And so, but I'm in New York and I need a job. And I talked to a recruiter there, and she put me in front of a few law firms. And I thought, well, what I'll do is I'll go be a paralegal, and then I'll go to law school, and maybe I'll be an attorney, maybe I'll be a sports attorney, maybe I'll be a sports agent or something like that. Because I kind of using that political science, using that all the history classes, all that background, and going into that area made sense, right? And I met with three law firms, and they were all working on big tobacco, and they were all defending big tobacco. And here I was, a kid coming out of Yale, and I'm like, I can't work for big tobacco. There's no way. And so, and I had three offers immediately, and I was like, that doesn't feel right. It doesn't feel like that's, if they're all wanting me, then I'm clearly under, I'm shooting too low. So I went back to the drawing board, made some phone calls, talked to some of my friends. They're in investment banking, and they're in trading, they're in finance. They're like, if I remember correctly, that calculus class, you didn't show up once the entire term, and you got an A. And if I remember, and this is one of the classes if I ever have a dream, you have those dreams where you like, oh, I forgot I have a test, or I didn't go to class, and so if I ever have a dream, it's about that class. I thought he's going to find out that I never showed up. Anyways, it's true. I had 100, and because I was really good at math in high school, and so that was I just checked the box to do calculus in college. So I had already done linear algebra in high school. So I was like, yeah, I'm pretty good at math. And they're like, you should come to Wall Street. And so I got introduced to some people, and I got hired by a firm called SG Warburg, and they needed a um, you know a young staff to help with their ADR arbitrage trading. And so I was on the floor of the New York Stock Exchange trading ADR arbitrage. And what is that? Well, I traded some Aussie stocks, and what we would do is we would trade foreign stocks on the floor of the New York Stock Exchange. And so, but you'd put them in a basket, and you'd have a stamp tax, and you would translate the currency, and then you could trade them on the floor of the New York Stock Exchange. So why would you do that? Well, you had US customers who want to own Australian or European stocks or Japanese stocks, whatever it may be. But they didn't want to go to those exchanges and trade them there. They wanted to trade them right here in New York, right? So, but if I could buy those shares on the UK and in the London Stock Exchange, and then sell them for a better price, whatever they're trading at on the floor of the New York Stock Exchange, well, then we would make a spread on that. And so that's arbitrage. And back then, if you remember, there were no Excel spreadsheets. All I had was a calculator that was about 3 times the size of this. And it was just big buttons. As quickly as you could press those buttons and get those numbers in, if you could do it.
Was it an HP 12C?
Well, this is an HP 12C.
Oh, is it? It looks like it.
It wasn't even this. It was like, I mean, it was like this big. It looked like one of those big old, phones that you find in your grandmother's house. Yeah, that's what. But that's what I was doing anyway. So that's a long way of saying that. Look, I came out of college. I thought that I was going to get signed by the Boston Bruins. I had some college debt. I had some credit card debt, and I thought that was all going to get paid off. That was not going to be a problem, and it wasn't going to be a problem until it was. And then so I lost my identity. I didn't have any capital. I was living in New York City. There were no jobs in the nation. It was 1993, 1994, and but I found a job on the floor of the New York Stock Exchange. And at that time, here's the crazy part. At that time, I was getting paid $28,000 a year to work full time in New York City, right? And so I'm showing up to work every single day, and like I said, I didn't come from money. I'm showing up to work every single day in the same suit. Okay, here's the bad part. It was blue. It was blue pinstripe.
Don't tell me same shirt.
It was blue. It was a blue pinstripe suit. So you can't. I had 3 shirts. They're all white. Okay, they're all white. I would start them so badly that they were like cardboard by, like the 3rd month. Anyways, but I had one tie. I had one red tie. And so finally my boss pulls me aside after a few weeks. He's like, Lavish, you have got to get another tie. You cannot come to work with the same tie every day. There's like food on it. He took off his tie and gave it to me. He goes, go buy some more ties. So the tie he gave me was probably worth twice as much as my suit,
Oh my God.
So yeah. So anyways, that was my illustrious start on Wall Street. $28,000 a year, working on the floor of the New York Stock Exchange, with the brokers throwing tuna fish sandwiches at each other. It was a crazy time. It was a crazy time. So
90s stockbroking was, for what it's worth, I was a limited time, but maybe late 80s, early 90s. I was actually in broking for a while here in Australia, so nowhere near as
yeah,
great.
with Macquarie.
No, I was with a little independent group called JB Weir and Son. So I was
Okay.
actually with National Australia Bank Treasury in London, and
Okay.
then because I'd gone travelling, and then I ended up with JB Weir in Sydney, who's since been taken over by oh God, I've lost track.
They're
Eva's,
all one bank now. Yeah.
that's
I mean,
exactly.
when I was at SG Warburg, it turned into SBC, USB. The SBC, Warburg, Dillon Reed, Payne Weber, like that all came in, and then it just got taken over by
Yeah,
BS. And I mean, it's like it was incredible how yeah.
just
So
became bigger and bigger, and mergers upon mergers upon mergers. So were there, you said you were in this space for 30 years, and you obviously moved around a few different businesses in that time, and different roles and bigger responsibilities and bigger budgets and bigger portfolios. Uh, did you see cracks in the system?
well, back then, no. I mean, back then I was just barely, I was trying to figure out what was going on.
Yeah,
So when did I start seeing cracks in the system? Well, that was a few years later. It was back in 1998. And so if you remember, back in 1998, I had just moved to Texas. I was working for a rapidly growing hedge fund. So it grew to be one of the largest in the world at the time. But there's this hedge fund in Fort Worth, and we were trading a lot of arbitrage, but different arbitrage. So we were trading stuff like merger arbitrage, where two companies are going to merge, and one stock is going to become another stock, or cash, or a mix of cash and stock. And sometimes it's really complicated, and you can arbitrage that. And how do you do that? You buy one side, you short the other, and you do a lot of work on the legal side to understand how strong that merger agreement is, and what the different things that could happen that could trip up that merger. And so, and you do a probability analysis on it. You annualize your return, all of that. So we were doing that. We were doing convertible arbitrage. We were doing long short pairs trading with different companies in the same sector. So, but anyways, why does that matter? Well, back in 1998, if you remember, the Russian ruble was devalued, and there was the ruble crisis. And so we're sitting around, and we're starting to get phone calls about these spreads. We're watching spreads just start getting really blowing out, getting super wide. And some of these spreads were like, they were trading like the merger was going to break. And we obviously we're in the circle, we're hearing stuff. And so we start hearing that there's a problem with a big, really big hedge fund with some prominent founders. And so, and we learned really quickly that it was long-term capital management. And this firm was founded by a couple of guys who were they had created the options pricing model, Black-Scholes, right? So Scholes was one of the founders. And so what they had done, for your listeners, is they had been doing these trades, but they were doing these interest rate arbitrage trades. And so, and it's where you can arbitrage the interest rate across border with currencies and hedging them all out. And so, but when you do an interest rate arbitrage trade, you're basically short volatility, right? So if the underlying bond moves just a little bit, then you have
You're
a
exposed.
loss on the other side. So the problem is they were doing these trades, but the volatility in these bonds was so low that they're like, well, we can lever these things up, 5, 10, 20. And then we started to understand they were levered over 100 to 1. And so, you put in they had $1 billion, they had $100 billion worth of trades. Now, back then, that was a lot of money. That would be trillions today. All right. So, but the people started hearing about this in the street, and those spreads started blowing out. And I got a phone call late at night from a buddy of mine. He's like, "Hey, do you have any exposure to Goldman Sachs?" Well, why does that matter? Well, Goldman, as hedge funds, you all have a prime broker, a primary broker, and that broker is your custodian, and they have your cash. They're your counterparty. They're custodying all your assets, and so they're basically your personal broker as a hedge fund, but on a big level, right? Well, we were not prime brokered with Goldman, so I was like, no, we're okay. We may have had we had some swaps on the convert side, on the convertible arbitrage desk, but there was nothing huge. I think we might have had some currency swaps, but again, we're talking about maybe $5 or $10 million out of a $700 million firm. It was not that big of a deal. So, but what we heard was that night, the Goldman Sachs CEO had walked into the New York Fed and had said, "Look, if you guys don't step in and rescue us, we're going to collapse, and it's going to take down the whole street." And so, nobody wanted to do business with Goldman. They were all, they didn't want to help them. But the New York Fed assembled. This is the first time that I really realized, wow, there could be some problems in the way we do business on Wall Street. And so, but the New York Fed did backstop them. How did they do it? They assembled a rescue team of other banks that came in and shored up Goldman. Okay, so one of the firms that voted against it, though, was Lehman. So, which is pretty interesting that you come around full circle back in 2008. Well, Goldman wasn't going to help Lehman. So anyways, so they get rescued, and we have normal people don't understand how close we were, how precipitously close to the edge we were, because if that firm had failed, the counterparty risk on that $100 billion worth of trades would have just reached everywhere, and it would have taken down other hedge funds. It would have taken down other, banks. It would have been catastrophic. So,
Mm,
but that was the first time that the Fed stepped in and completely manipulated the situation. And so
mm,
it was telling, and I knew, well, this is going to happen again. You just didn't know when or what or how, what was going to be the black swan event. Well,
mm.
and then we had a number of things that happened since then. We had 9/11, and we had the tech bubble burst, and then 9/11, then we had the great financial crisis, and then we had COVID. So,
Yeah.
all right, that was a long way. That was a long explanation, but that's when I first, realized that there's some serious cracks in the system, and leverage is so dangerous, and it's so dangerous from each trade. It can be so dangerous from your portfolio. It can be dangerous at the fund level, at the firm level, at the bank level. And now we're seeing is it can be pretty scary and potentially devastating at the sovereign level. And
Yeah.
that's the part that's the part that's keeping me up at night now. Not that I didn't make the hockey team. It's that, sovereign debt risk. So
So let's talk about that because I think that's right. What we've seen in the past, it used to be a big deal if an individual or a small company would go into liquidation, Chapter 11. Then it became bigger and bigger, and it was bigger and bigger companies. And now, as you say, we're seeing it at the national level, at the sovereign level. Um, I know you've talked about debt spiral to death, but you're very good at explaining it. So a lot of people, I had concerns through COVID about, okay, this is fine, but what about the costs? Like, and I don't mean just financial costs. I mean all sorts of human costs, social costs, etc. But financial is part of that. And nobody wanted to know, and nobody really cares. And you mentioned debt to people and ridiculous levels of debt, not only unsustainable, but what's the word? Like they can't even cover the interest on it. You know?
yeah, there. Well, yeah. Let's talk about that.
Yeah.
So,
So why is it a problem? I think to huge numbers of people, they just go, debt can go on forever. I mean, you've got the
yeah,
modern monetary theorists who think all
yeah.
sorts.
No, they fail. They all fail math. The grade 11 math, as Greg Foss would say, they're absolutely wrong. They're absolutely 100%, and they will be catastrophically wrong. And they don't get it. They're in my feed all the time, and they don't get it. And it's unnerving, just how they dismiss the reality of math. Okay, so let's walk through it, because I like math, because
Yeah.
that it gives a pretty strong underpinning to what you're looking at, and it helps you understand what's going on, right? So now I'm from the United States, so we talk about the U.S. and the U.S. it's really important because the U.S. is it's one of the drivers of the global economy, one of the main drivers, right? So
And
um,
the reserve currency.
yeah.
Yes.
So if we look at the US, we have 31.5. Actually, now we're just under $32 trillion of debt. $32 trillion of debt. That's the funded debt. That's those are the bonds we have outstanding. It's even worse though if you add all the unfunded liabilities. There's $170 trillion of unfunded liabilities in Social Security and Medicaid, Medicare, and all that we're not even adding in. So it's really about $200 trillion of debt. It's so monumentally large. It's absolutely, it's nearing ridiculous proportions. But let's just put that over there for now. Let's just focus on the debt that's treasuries, okay? The debt that's out there that are US treasuries. So the problem is, Carrie, is that if the United States, if you're a company, okay, and you have debt, and your revenues are not covering the interest on that debt, that means that you have to take out more debt to pay the interest on that debt, which
Mhm.
makes you that, and we call those companies, if they're listed on the exchange, we call those companies zombie companies. Like they are just they're like bound to implode at any moment. They're dead man walking, right? So if the United States was a company listed on the floor of the stock exchange, it would be a zombie company. And that's the scary part. And so what people need to understand, and why does this matter? Okay, let's walk through the numbers, okay? So right now, okay, and these are numbers that come from the Congressional Budget Office, right? This is Congress. This is a committee that puts together these numbers, which means that they know it. These are not just made up out of nowhere. These are coming straight in from their budgets and their accountants, right? That's number one. The projections. So the numbers that are passed, those are real, okay? But those come from the CBO, okay? But the projections that I'm going to talk about here are extremely optimistic, okay? So, and that's another scary part. But let's just walk through the numbers, okay? So everybody looks at debt to GDP. Why do they do that? Well, debt to GDP gives you an indication of how healthy the country is financially. Why? Because how much of that debt is being serviced by your tax base, right? So GDP, the gross domestic product, is that's the gross production of the United States, right? That's how much the government makes. Not really, it's how much we all make, okay? It's how much, that's the tax base for the government. So that's how much the government gets to tax. So that's how much they get to collect. They're not really earning anything, they're collecting, right? So, but if you look at our GDP, we expect our tax base, our this year in 2023, the CBO is expecting to collect about $4.8 trillion of taxes. Now, first of all, that's high because it didn't take into account that we'll probably go into a recession this year, and our tax receipts are lower as the stock market had sold off over the last quarter of last year. So the tax revenues this year are lower because the capital gains tax is a major portion of that, right? So let's just put that there, though. Pretend it's really 4.8 trillion. Well, the problem is you've got three main mandatory expenses in the government. Okay, these are mandatory because they're either signed into legislation or they're long-term contracts with large companies that are doing defense work or contracting, right? So let's just talk about those three expenses. Number one, you've got your entitlements, which is Social Security, Medicare, Medicaid, and that totals up this year. They're totaling that to be $3.8 trillion. Okay, 4.8 minus 3.8. Now you're down to 1 trillion. Okay. Now, your discretionary expenses, let's say they cut out every single program except for defense, and that's the only thing that they kept on. You have to account for defense, which is about $800 billion, according to what they're admitting to. Okay, so $800 billion. Now you've got $200 billion left. Okay, 4.8 minus 3.8 minus 800. Okay, everybody's with me. So you've got $200 billion left. Well, what's the expected interest on the debt this year? The expected interest is $640 billion. So now you're $400 billion in the hole just on that expected interest. However, the interest expense is much higher than that. And we know it's much higher than that because of what we've seen the Treasury saying they need to borrow in the first quarter of this year. So the problem is, number one, just getting rid of all other discretionary expenses, you're still $400 billion in the hole. However, you do have another $900 billion of expenses. So we're really about $1.4 trillion in the hole that they admit to, okay? But here's the problem. Number one, when you operate in a perpetual deficit, right? So you're always losing money. That means that you don't have enough money you don't have any income to pay the bondholders when their bonds mature. Because remember, the way a bond works, this, is you exchange money, give the government $1,000, they give you a bond, right? And so they give you interest on that bond. And at the end of the term of that, whether it's 5 years, 10 years, or whatever, when that matures, they give you your $1,000 back. Well, where's that going to come from? They don't have the $1,000. So what do they do? Well, they issue more debt because that's the easiest way to do it, right? And we'll get into that. But so as you issue more debt, the problem is they're retiring debt that is yielding somewhere between 25 basis points and 1.5%, right? So let's say that all the debt on the books that's being retired is about 1%, right? Well, you're issuing debt now at somewhere between 4 and 5%, right? So at least 3.5 to 5%, somewhere in there today. It's gotten the rates have come off a little bit, but let's just say it's about 4%. That's 3% more interest that you're paying every single year on all the debt that you're issuing. Okay. And so this is what we call the debt spiral, because that just means that your interest expense grows, your debt grows, your interest expense grows, your debt grows, and you can't. So what are the solutions? Right. This is the debt spiral. It's like, a good friend of mine, Natalie Brunell, likes to put it. It's like using your Visa to pay off your MasterCard. So if you're a single parent, you're working a few jobs, you've got your mandatory expenses, you've got your mortgage, you got your car payment, you have to pay for food and your kids, right? So you can cut out extra expenses like Netflix and extra clothing, but those are things you have to pay for. The problem is when you get to a situation where you have high inflation, you're not able to pay off these things, right? And so what are you doing? You're taking out a credit card. And the interest rate is high on that, and then you wind up you're paying interest on that debt that you're taking on. And when you sooner or later, you run up that credit card, you're at your limit, you have to take out another credit card. It's literally what we're doing here. Okay. Now we have the benefit because we're the United States. We could do this for a very long time. We've been doing it for a very long time. However, here's the issue, right? So you've got three choices. You can either have austerity, which means that you cut spending. Well, that's political suicide. Neither party wants to do it. Both parties wants to pressure the other side into making a mistake of doing it. You'll lose votes. You can't cut Social Security. You can't cut spending. You just can't cut entitlement programs. So that's not going to happen. The second thing you can do is you can raise taxes. Now you raise taxes and that will give you an immediate boost, right? However, that also impacts your productivity negatively long term. So you wind up in the same spot or worse anyways. It doesn't work. Okay. And it's not really popular. So then what's the third thing you do? Well, the third thing you can do is you can just issue more bonds, which is what we do every single year. And so that's why we're in the debt spiral. And there's just no way out. And it's so bad that the U.S. Treasury put out a report recently, and it was a review of their 2021 finances, and it was like the 2021 fiscal review was the name of the report, and the subtitle of the report, Carrie, this is something that's put out by the Fed, and I'll send you this chart if you want to put it in your podcast here. You see here that the what it's showing is how rapidly debt to GDP rises. And it's like, it goes, you can see it there, how it goes straight up. Okay. So they printed this, they published this, they said an unsustainable fiscal path. That is the subtitle of the report. And they just broadcast the world that if we keep doing this, sooner or later, this is just going to collapse. And they know it. They absolutely know it, and they admit to it. But what's the solution? There is no solution. There's only one solution. The only solution is to kick that can down the road as far as you can for as long as you can, which is why I talk about inflation so much, because the only solution that they have is to perpetuate this and to prolong it. How do they do that? Well, they do that by sneakily, taxing you in a way that you don't even know it's happening, and that's through inflation. Okay, how do they do that? Expansion of money supply, the Cantillon effect. So what will happen is prices go up, nominal GDP rises, right? Everything's costs more. You're making more money. The revenues are higher, but it's because of inflation. It's because there's more dollars. So your tax base goes up. And as you're issuing debt that you issued debt 5, 10, 15, 20 years ago, and it's coming due, well, you're paying down that debt with tax dollars that are worth far less than when you originally issued that debt, because what they need is, and this is what we call the negative real rate of return, where the interest on your debt, right, does
Hmm.
not cover the inflation, right? So if you're making 4% on your bond, but
Yeah.
inflation is 6%, you basically lost 2% this year of your purchasing power. And so they know this, and they know that they need to keep inflation up in order to keep inflating away some of that debt, keep inflating. When if they could let inflation run hot 20% a year for a few years, they would love that. But they can't, because they would have a major social upheaval. So they can't allow that to happen, right? So what they do instead is they manipulate the numbers, make CPI and PC look a little bit better than they really are, and then sneakily let you get inflated away and not even realize that this is happening. So it's evil. It's sickening to see, and I'm tired of it. And this is why I talk about Bitcoin so much, and hard monies like gold and silver, and sound money like Bitcoin. And so that's a debt spiral. We're in it. There is no solution. It is not going to get any better. When you look at the numbers, they admit to the fact that there's going to be a $10 trillion outlay by 2023. We're going to be so far in deficit. It's and debt. It's actually mind-boggling. So it all comes down to, look, we are built on a system of trust. The
Mm.
US dollar and the US Treasury are the global reserve currency and asset, right? So um, people trust that they're going to be around and they're going to be good money. The problem will come when people stop trusting that.
Mm.
And there will get to be a point where we crowd out the public balance sheets, the pension funds, the endowments, the other sovereigns, and they simply cannot buy the amount of debt that we have to issue in order to pay off our old debt. And
Hmm.
it'll get to a point where that confidence will crumble. Well, when does that happen? It happens when we have a bad bond auction. It happens when the treasury market becomes unruly. And
Mm.
then when you see those things, then we just what ends up happening is the treasury steps in, the Fed steps in, we have QE infinity, where they just come in and buy every single piece of paper to keep that market going for as long as they can. And that's what scares me. I
Hmm.
don't Let me back up. I don't think that anything's collapsing in the next month or two. This is a long-term process, and fortunately for the United States, we have the benefit that we're the reserve currency, and we'll be the last currency to stand, and so we'll swallow all the other currencies. It'll be like the dollar milkshake theory that Brent Johnson talks about from Santiago Capital. But we have the benefit of that. But that's my limited worldview. When you guys out in Australia, I think you're going to be hurt by this. And
Mm.
that's the scary part. There are going to be a lot of people hurt by this, and it's
Mm.
not fair and it's wrong. And so we want to bring that to light and get people to understand Bitcoin as quickly and as thoroughly as possible, so they understand why this is a different system and it can solve so many problems that this system allows and has. So that was a long answer. It's getting dark in here.
Is it? Yeah, it's getting late in the afternoon there, and it's what time of year over there? It's like springtime. You're heading.
So no, it's getting to spring here. It's getting to
Okay,
spring.
just coming out
It's
the other side.
March in Vegas is usually just windy and rainy. So, but yeah, it's stormy season. So monsoon.
There's the the question that's going through my mind when I was in stockbroking, and I would say I got started late 80s, and I was reading a book called The Great Reckoning by James Dale Davidson and William Rees-Mogg, and they were talking about this stuff then. That's like mid to late 80s, right? They
Yeah.
wrote that book. So they've been kicking the can down the road since then. Uh, Having said that, so I guess my question is actually around the timing issue. And what could this look like in reality? I was actually online, we were talking about the French protests at the moment. And
Yeah, yeah.
I was kind of saying, yeah, but the French are different. Like in us English speaking countries, we tend to be a bit more scared of our government. In France, the government is scared of their people. Once you've seen physical heads roll, you tend to be a little bit more
Yeah, they
careful.
have a different history. Yeah,
They have a
yeah.
different history. So in terms of timing, it feels like for all that kicking down the can down the road, and it seems like it could go on forever, and it seems to have gone on far longer than any of us could have imagined it could have gone on for. And yes,
Hmm.
America's, as Foss would say, the fastest horse in the glue factory. But the uh, question I've got is Mark Moss talks a lot about the coming together of three big cycles at the moment. We've got, political,
Hmm.
social, cultural, we've got technological, and we've got financial.
Hmm.
And all of those are in combination or they overlap with what's commonly known as the fourth turning. We're going into a crisis period. We're technically in the beginning of a crisis period, according to the fourth turning.
Hmm.
In reality, how do you imagine this playing out and over what kind of period of time, knowing that these things often happen gradually, then suddenly?
Yeah, I do think that we have a period here where we are going through a reset. It's a good way to put it. I do think it takes longer than people are scared about. I don't think it happens, overnight. This is not like this. They're going to print one more time, then it's over. I don't think so. I think that we can do this for a while, and it happens to do with people's confidence. And I think they're going to, not to get into the CBDCs, but I think that is definitely square in their sights that the central banks want CBDCs in order to be able to control these currencies and the people and make sure they control where the capitals flow and keep them within borders in ways that they can. So, but just put that over here. I think what happens here is what's different about when that book was written, right? You said it was written in 75. Is that
I don't actually know the precise date, but I was reading it in the mid 80s and it had already been around
okay?
for a while. Yeah.
Okay, so well, the debt to GDP back then was a fraction of what it is today, and
Yeah.
it's growing rapidly, really quickly. Okay, and now we're in the point where it's just going to keep growing. Okay, so the problem is there's the sheer amount of debt that's out there now, Carrie, is it's starting to show cracks in the system that it's not like one large hedge fund manufactured this massive debt hole that everybody kind of just said, oh, they'll be okay. They created Black-Scholes. These guys are Nobel Prize winners, right? This is systemic. It's around the entire world, and it goes all the way down the consumer. How much debt we all have everywhere. You know, and so the Airbnbs and the extra cars and the cars that cost hundreds of thousands. Like I don't know how many people that have Teslas that I can't believe that they own Teslas.
Mm.
And but there are people, but that's not it's just everywhere.
Mm.
The sheer amount of debt. So what does it mean? Well, we're starting to see cracks in the system from that systemically across the whole world. We've seen it in Japan. This past summer, they started yield curve control. Why are they doing that? They need to manipulate their yields. Why are they doing that? They need higher inflation. Why do they need higher inflation? Because they have so much debt. Their debt to GDP is 250%. Okay. So, and they've got perpetually low inflation. They're a net exporter. It's just there's a different dynamic there. But the problem is they're going in and buying all their debt. They're now the marginal buyer, and they're manipulating their interest rates in order to keep it to a certain spot. And it gets to the point where the yen is on the verge of imploding, right? So you saw it move from 120 to 150 this summer, okay,
Mhm.
and this fall. And so when you have so much pressure, okay, just to give your listeners really quickly what this means. When you have so much pressure on a currency and on a reserve, right, on an asset for a government, what's happening is if you look at the yields of the 10-year US Treasury versus the yield of the 10-year Japanese Treasury, the difference there was just growing rapidly. We were raising rates just, every month, boom, 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 25, 50, 75 basis points, we're just moving them up rapidly, and they were holding theirs at 25 basis points. So, well, if you're a Japanese investor and you've got money in that treasury and you're seeing the rates go up in the United States, and you think, well, you can get a better yield on your investment over here. It's just a natural, right? So what will happen is the investors will sell Japanese treasuries, right? They'll get yen for those. They'll sell yen to get US dollars, and they'll go buy the US treasury, right? That's just that until it gets into parity. And there's futures that are involved, and it's a little bit more confused than that, but this is just interest rate arbitrage, right? It's just, it's interest rate parity. So, but because there was so much pressure, there were so many sellers of Japanese treasuries, the Japanese government had to stand there and buy all these, and they became the largest owner of their own debt last year. So now they own over 50% of all Japanese debt, and they're the largest owner of all their debt. Okay, so there has to be an escape valve, and that escape valve was the yen, and so that was just like the first. Wow, that's a lot of leverage over there. Okay, they've been doing it for a very long time. Different system, different demographics. Agreed, but just it is alarming.
Yeah.
Then you look at what happened in Europe this past year. Okay, so Europe just 2 years ago, they had $15 trillion of negative yielding rates on bonds. Okay, that's not real rate. I'm not talking interest rate minus inflation. I'm talking about negative nominal rates, where the German Bundesbond they were yielding negative returns. So if you're a pension fund and you give $100 million to Germany for their Bundesbonds, you'll get less back when at maturity. They're yielding negative. And so what happens when you start raising rates rapidly? Well, you can see the problematic areas, the regions that have weaker banks, Italy, Spain, Portugal, Greece, they start to show problems. Why? Because, well, in a rising rate environment, when you have an inverted yield curve, meaning that yields that are further out in maturity are lower than yields up in near term, well, it makes it really difficult for the banks to make money, right? So they're typically borrowing short term and lending long term, right? So to simplify it. But anyways, so, well, immediately so the ECB held rates negative, and they had double-digit inflation happening out in Europe in the summer, and they had rates still negative. I mean, talk about just gross negligence, incompetence. Christine Lagarde, I can't even believe she's not in prison. Forget about because of everything else she had in her background. I forget about being the head of the ECB. Like, this is just, it's astounding that this person's the head of the ECB. I mean, the gross negligence, and for her to just sit up there and say, when asked by a reporter, well, when will inflation come down, or when will you fix the problem? She say, it'll come. Like, it's just, anyway. So going into the summer, they finally raise rates in July. Finally get them to positive territory. I think they raised them to zero, and they were raised them to zero. And the reaction on the Italian 10-year treasury was so dramatic and profound. They had to immediately come out and announce, well, we're going to be there. We have Italy's back. We're going to backstop them. We have a new instrument. It's called the transition protection instrument. And basically what it means is it's yield curve control, the same thing that Japan is doing, but yield curve control on specific maturities in specific countries. And the crazy thing about this is that there's a settlements exchange, a cross-border exchange that they settle every night. It's called Target 2. And if you look at the Target 2 balances, the money that's owed to Germany is up over $1 trillion now. And there's a couple of countries in there like Luxembourg, and I can't remember who else is in there, but they're smaller that are owed money. Every single other country owes them money. And here's the crazy thing. Italy owes them the most, owes Germany the most. Another borrower from Germany's balance sheet is the ECB itself. The ECB owes over $300 billion to Germany. But here's the crazy part, Carrie, is there's no way to reconcile this. There's no reconciliation of it. It just grows. And so I think at some point, Germany's just going to walk away. They're going to say, this is okay. We cannot fund the rest of the region anymore. We've got to, we're out now. But that was yet the second thing that we saw. And then you're well aware of this, the pension fund issue out in the UK. And for your listeners, I'll make this one really quick because I'm going into if this is boring at all, you've got to cut me off. You've got to tell me to
Not in the least. Personally, I could listen to this stuff all day, but
So the third thing that happened was in the UK. Okay, you had so when you have low interest rates, very low interest rates, the problem is for these companies that need to make returns, they need to make yields, they need to grow their assets. Why do these companies need that? Well, when you're a pension fund, you have pensioners. They give you money, they pledge money into your fund, and then you've pledged that you're going to take care of them later. And that's an obligation. And they can estimate what their obligations are in the future, right? But they know that they've got to make a certain return to pay out those obligations in the future. Okay. But the problem is when you have negative yielding rates, or you have interest rates that are down to just the minimum, 25 basis points, 50 basis points at most that you can make on these bonds. Well, what do? And so if you're a UK pension fund, you can use a swap. It's called a leveraged debt instrument. And what does that do? Well, the leveraged debt instrument allows you to buy bonds for just a fraction of the notional of it. Okay, so you're basically buying them on leverage, right? And so these guys were levered up 5, 10, 20 times to 1. When I was using swaps, and I would do swaps. Okay, let me back up. First of all, swaps are not bad in and of themselves. Swaps typically can help you hedge out risk. I use them to hedge out dividend risks. I use them to hedge out currency risks, interest rate risks. I use them all the time in the hedge funds to limit risk, to isolate the return I was trying to get to and not have to worry about this other risk over here. However, they were not using them to limit risk. They were using them to leverage up, ramp up the returns that they were getting. So if you have a coupon on a bond on a UK gilt, okay, the UK Treasury, if you have an interest rate that's 1%, okay, and you lever that up 5 times, well, now you're making 5%. You lever up 6 times, now you're making 6%, right? Okay. The problem is it's a swap. And the collateral for that, the underlying collateral for that is the gilt, right? So what happens? Well, you've got this new Treasury minister that comes out. And if I get any of these titles wrong, I'm sorry, because I am not an expert on UK politics or cabinet.
Chancellor of the Exchequer?
Yeah, okay.
Maybe.
So the new one comes out and says, we're going to have historic tax cuts. Across the board, they're going to be basically some of the biggest tax cuts they've ever seen. And the first question they get is, awesome, how are you going to pay for that? Well, we're not. He had no answer. And so the bond market freaked out. Why would they freak out? Well, because when you don't have a way to pay for it, that means that you have to then monetize your own debt. You're going to have to issue more debt, print more pound, buy the debt yourself, and it's inflationary. So they immediately thought, oh God, this is just terrible for the pound and for the UK gilt. So sell the gilt. And so the gilt started collapsing. Well, then they were collapsing and these pension funds got margin calls. And so when you get a margin call, you don't have a choice. Your broker sees you're coming in on margin. I'm selling your collateral. So I'm made whole. You lose your money, but I'm made whole, because you haven't been able to you can't put up collateral for this to, extra collateral to meet the margin call. And so what happens? Well, it snowballs, and then you hit another margin call at another pension fund, and they trigger margin calls at another pension fund. It just grew, and it grew so rapidly, Carrie, that in 2 days, then it was like literally overnight that the UK pension funds went into the Bank of England and said, "You've got to rescue us, or we're going to be insolvent this afternoon." And so, but that was number three.
Yeah,
Okay.
yeah,
Flash forward, to, to Silicon Valley Bank. All
yeah.
right. And so what happened there? Well, let's go back to the treasuries. All right. You're in fractional banking. What you do is you get your deposits and you lend out, you take a smidgen of that and you put it in reserves and you lend out the rest of it. Right. So
Mhm.
you may keep 15% and you lend out the rest of it. Okay. But the problem is, what do you do with that capital? You don't just let it sit there. You have to do something with it. Well, you buy treasuries typically because it's the safest thing. Okay, so
Mm.
when you're buying treasuries back in 1990 or 2019, 2020, 2021, 2022, and you or 2021, and at the end of 2021, you've got the Fed, it comes out and says, we don't see inflation getting to be a problem. We don't expect to have to raise rates at all. If at worst, and if you look back at the Fed dot plots, if you look back at how the Fed how they all communicate what they expect, their expectations of rates are. They plot them out on year to year, and you've seen it. Well, their their dot plot, on average, at the end of 2021, projecting to the end of 2022, they expected rates to be at 0.86%. They were off by 4%, which is 4 times what they thought they were going to be. 4 times. So it's monumental. That 4x is it's incredible how large that is. Okay. So there's a lot of banks who have hundreds of billions of dollars that are underwater in treasuries. Why? Well, because when interest rates go up, right, the yields go up, then the price of the bonds in the market goes down. So if I want to sell this bond, I've got to sell it for lower value in order to generate enough return for the person who's buying it. And when you've got bonds that are long-term bonds, these are 10 or 20 or 30-year bonds. Well, that loss gets magnified. It's duration
Mhm.
risk. And so it gets magnified to huge levels, right? So these bonds were down 20, 25, 30, 35%. And so now you have customers who are saying, oh God, I don't want to be one of the guys who can't get my money out. So I'm going to get my money out first. And then people start whispering and hearing, oh, they're impaired. Their balance sheet is impaired. They don't have anywhere near as much money as they need to have for all of us. And so that's when you have your classic run on the bank. But they could have protected themselves. And typically, what a bank will do is they'll do an interest rate swap in order to swap out that variable rate, or swap out that rate to make sure that they lock in whatever rate they have. And so, but they didn't do that. They didn't have any hedges. And so, this was more of an interest rate risk event than a credit risk, but it could easily turn into a credit risk,
Mm.
like a credit event, if it happens, and contagion sets in and we have more banks that this occurs in. So, but it's all, look, it all has to do with leverage,
Mm.
rapid rise of interest rates, manipulation of rates. We have a system that is ill. It's sick. It has a disease. That disease is debt, and there's no cure.
Unbelievable when you put it all together like that. And you can read these individual articles about different pieces of the system going over time, but to hear it all put together like that,
It's kind of depressing, and I'm
pretty
sorry about that.
overwhelming, isn't it? Pretty overwhelming. I hear people say, because they've done the math, and the math says US dollar to zero, all currencies to zero, really. QE infinity equals, US dollar zero. And they'll say something like, but I rest like a baby because I've got Bitcoin.
Mm,
I don't
mm,
feel that. I feel the social upheaval in the next 10 years could be horrifying. I feel
mm.
like the pain people are going to go through is appalling and terrifying. And whilst I understand the math of scarcity, I still don't have full faith
So here's what I would
that
say,
it'll
and
happen. So,
here's what I would say about that is that
yeah.
yeah, you get look, you do get some people who are just like, hey man, I own it. We've been talking about it. If you don't own it, it's your problem. Yeah, well, there's a lot of misinformation, disinformation, purposeful disinformation about Bitcoin out there. So let's just walk through it though. First of all, I don't believe we have a monumental collapse of the system. I just don't believe that that happens. I believe what happens is we end up having what's going on right now with the BRICS nations. Okay, so for your listeners, what does that mean? It's the Brazil, Russia, India, China, and South Africa. Okay, and they're talking about being an extended BRICS, which would add Iran and Saudi Arabia. So BRIICSS, right? So what is that? Well, they're banding together and agreeing to settle trades in alternative currencies outside of the U.S. dollar. The U.S. dollar has a lot of strength, and we talk about the petrodollar system. And part of the reason it has a lot of strength is because most oil trades are settled in US dollars. And so because the US dollar is the global reserve currency. And so it's an easy exchange between countries. Rather than the Venezuela or rather than Spain giving Russia US dollars, euros, they're going to give them US dollars. Well, that stopped this past year. And we talk about the weaponization of the US dollar. Well, we stepped into it this year with Russia. So what do I mean by that?
Yeah.
Well, so the BRICS nations want a way to settle in a different currency, whether that's yuan, whether it's rubles. I think it's going to be the yuan, and I think it's going to be gold, and I think it's going to be Bitcoin. And so as that happens, you have this other payment system that's being built out. And remember, look, we're a fraction of the holders of Bitcoin. I mean, it's held all over the world, and it's used all over the world. And really, the ones who use it the most are the countries that you need it the most, like Ghana. So, we don't use it here in the United States. I don't go to Starbucks and use it, but they do. They use it in El Salvador. So if you don't want to have U.S. denominated debt, you can denominate your debt in Bitcoin. Well, that's the future. That's what El Salvador is trying to prove. So here's the thing: is I think that we get a parallel system that's built out. Carrie, we get enough people that believe in it, trust it, use it. It's easier. You can onboard people easier. They can have wallets that are easier to use. It's much more easier to understand. How does that happen? Well, we get some regulation around it here. We get enough investors in it institutionally that the volatility dampens in it. It doesn't trade at 5 or 10% of the clip anymore, and it becomes a better store of value long term. Now I believe it, and I do rest a little bit easier knowing that I have some. Why? Because if the entire system did collapse, well, at least I would have some sort of currency that I would have control of. You can't load up a briefcase and go cross border with gold. You just can't. But Bitcoin's in your brain.
Yeah.
So that's the things. I don't think that we have a monumental collapse. I just don't. I do think we have systematic systematic credit collapses that do lead to what we call QE infinity. I think it's these large printing programs where you start printing 20 or 30 trillion dollars of debt. We go in the hundreds of trillions, and people will start blinking. but I don't think they start blinking for a little while yet. I still think they believe in the system. They trust the system because it's the only thing they've known. I mean, the U.S. has had the reserve currency for what, 100 years?
Mm.
So, you know, it's we're getting to that point where people may start to question it, but it's not you and me, it's our kids and grandkids that are going to do it.
Yeah.
So that's my personal belief. And I do believe if you talk to Jeff Booth, he has high hope that we have an operating system that runs parallel and that we
Hmm.
can onboard to, and so there's not a catastrophic collapse, but we can onboard to that. And that's my hope. That gives me hope. But that's
Yeah.
why we're talking about this every single day to get people to understand it. It's not some Ponzi scheme. It's not some fly by night crazy, in crypto coin or cryptocurrency. Like this is different. It's
Hmm.
completely different. And so if we can get people to understand how Bitcoin is different, I mean, that's our mission. So
Yeah, it really is. And it's the first thing I say to people these days when they ask me about Bitcoin or if it comes up in conversation, which of course it does all the time, is that there's Bitcoin and there's everything else, and it is not cryptocurrency. And if that is the only thing I can kind of get across to someone to get people kind of involved, then that's a win in my book.
yeah.
Um, Okay, and I think it's lovely to hear it from you, and I have heard it from Jeff. And I had Lisa Huff on the program a little while ago, and
Oh yeah, I
just
love
to
this. Yeah.
hear that amazing.
Yeah.
Just to hear, I think because I'm in a tiny little corner of Australia, I'm not involved in the industry except to the degree that I go to meetups, and we recently had a bush bash in Beechworth here in Victoria, regional Victoria. Uh, so I'm not seeing the infrastructure build out. I'm not seeing the size of the take up. I'm not seeing this parallel economy build up. I hear or see, like, for instance, the news recently that companies are now able to include Bitcoin on their treasury
Yeah.
assets.
Yeah. Yeah.
So I'll see
They
little
can,
bits like that.
they
I'll
can,
see El
yeah, they
Salvador,
can, yeah,
Nigeria. Yeah,
yeah.
sorry, tell me.
No, that's right. And then out here, they can gap account for it, so they don't, they can market to market properly rather than be impaired only. So, and that's a big deal. Yeah.
So
So
for
I
anyone
think
who might
if
be,
we can lead the regulatory clarity, if we can get the regulatory environment here in
yeah,
place where yeah, look, if it's a security, regulate it,
mm,
and regulate Bitcoin the way it should be as a commodity, And so, but if we can get some clarity around that, it'll make people understand how it is different. So, but I interrupted you. Go ahead.
no, we're getting quite a number of politicians on board now in the US, aren't we? Are we getting closer?
I mean, look, one thing I can say, and that the thing that worries me about Bitcoin and why I think it will take a long time is that it's it's tremendously disruptive. And
Yes.
so it's
Yeah,
disruptive because you can move billions and billions of dollars of Bitcoin for pennies,
yeah,
just a few
yeah,
dollars. Whereas in the banking system, I mean, they gouge us for every single transaction. If I want to send a $2,000 wire, it costs me $45. I mean, it's just insane. If I want to send $2,000 on Bitcoin, it's like 19 cents or something. I don't know. So, I mean, it's just incredible. That was an exaggeration, but it's just incredible, right? That actually $2,000, yeah, that's probably high. So, you know, um, but that's the thing is that people don't, what we have to understand here in the United States is our politics are driven by the donations. The donations are made by the largest companies and
yeah.
largest CEOs, period. And so if you think that Jamie Dimon does not understand Bitcoin, you're naive. He understands exactly what it is. He knows exactly what it is. He knows exactly how it can disrupt his business. And so he's going to do everything he can to dismiss it, make people think that they're you know they're foolish to even consider it and to take it seriously. That's his mode of operation right now, is to make people think they're stupid if they consider it. So we'll see. I think he's on the wrong side of this one. It's his business, that's why, but he's on the wrong side of this one.
And who knows if it happens in his lifetime. I did get a different point of view on that, by the way, on this podcast. There was a guy who goes under the name of Spartacus Huddle. He works for JP Morgan.
Yeah.
And he was saying you would be surprised how little people understand. Like this guy is seen as kind of the Bitcoin expert in the business because nobody else really gets it. And then they get interested for a while during the bull market and then they kind of back off again.
Yeah, it's a risk on asset to them. I see it I see it in the institutional world. It's true. So, but when we do get regulatory clarity and we get stronger, deeper, broader understanding of it across the board of how Bitcoin is different, that's when things change. And that's when it becomes, that's when it really solidifies itself as a separate investable asset. And that's the important part. Once we get to that point, and that could be driven by in haste by something like a bank meltdown, people looking for places to put their money that's safe. That could happen, because you try to go buy gold, your choice is to buy paper gold and on an exchange, or you're trying to buy real gold. It's difficult sometimes to find and get delivery quickly. So,
and doesn't work for institutional level. Where you need you need institutions demand Bitcoin regulation, then finally we'll start to get some traction, I can imagine.
Yeah, I agree.
James, I know it's been a hectic day for you, and you're probably exhausted, and you said it's getting dark, and I don't want to overstretch your time. It feels like we're finishing on a more positive note. If you had one thing you would like to get out to people who may be current Bitcoiners or no coiners, what would you want to leave us with?
Yeah, I mean, look, I do. Bitcoin is absolutely hope. I agree with Michael Saylor on that. I agree with Jeff Booth, good friend of mine, Jeff, and he, I really respect the way that he always talks about things he tries to get outside of our current place and our worries. And he said, look, the great thing is we have hope. Imagine if we didn't have Bitcoin. And he said, don't even imagine that. Just focus on the fact that we do have it and try to teach everybody about it. So for me, it gives me comfort that I know that we have something that we can turn to. And whether that's in the United States or not, we do have something that we can turn to that is a stable system. And so that is hope. And for the people who don't understand why it's different, it's all about the money. It's about the manipulation of money and the fact that Bitcoin simply cannot be manipulated by a bad actor, by a central bank. That's what makes it different. That's what makes it unique. That's what makes it strong. And that simple fact is what you need to focus on. And so that I don't rest perfectly easy because of all the stuff that's happening in the world. I too am anxious, but I do take comfort in the fact that we have this, and it is my insurance against certain events happening. And I do think that it's the lifeboat, the ultimate lifeboat for us in the end. So it's good.
Beautiful note to finish on. James, I cannot thank you enough and appreciate you enough for the time you've given up to be here in a crazy world. Do you want to give a bit of a plug for Bitcoin Opportunity Fund?
Well, thank you. I thank you for having me, Carrie. I sincerely apologize for being late. The Bitcoin Opportunity Fund, it's for accredited investors. Not my rule. It's the SEC. We love them, the SEC. Okay. But it is it's a deep value Bitcoin focused fund. We only trade Bitcoin. If we short something, it's going to be something that we believe is a direct competitor to one of the companies that we believe will be disrupted by one of the companies that we're invested in. So, but what we do is we can invest in both public and private companies. We can invest in early stage, late stage, it doesn't matter to us. And what we're doing is we're just taking advantage of the opportunity anywhere we see it. It's unique because we can do anything from buying a public miner and then hedging it in a way that a typical investor cannot do, buying public miners debt and hedging it with stock in a certain way called delta hedging. Or we can buy private companies. We can buy Series A. We can buy Series B that are deep discount in the hole because they're companies that are struggling. But that's the important part, is we're trying to get capital into the system to shore up some of these companies that have been hurt so badly by all of the contagion of the the fraud and the mismanagement of things like Celsius and FTX, and but that's been damaging to the industry, to the Bitcoin industry. And so we know companies that have struggled to raise capital where they shouldn't be. They're good companies, they're run by good managers, strong managers, and we believe that ultimately that the Bitcoin ecosystem grows just like the internet did back in the late 90s. This is the same kind of we feel like we're in the same shift, that same paradigm, so that moment, and it's a tremendous time to do it. But if you're an accredited investor and you want to know more about it, please reach out to us at bitcoinopportunity.fund. And then for the rest of your listeners, one of the things I think is important is understanding what's going on around you. And so I write the informationist newsletter, and you can find it on my Twitter handle. It's my Substack and my Twitter handle. I put out at least one free one every single month, so you don't have to pay for it. But and some other stuff. But it takes one complicated subject, one complicated financial topic that is around us, that's happening, and it simplifies it for people weekly, and it's gotten great feedback. I love doing it. I love talking to people, making them feel smarter. You can be a teacher, a fireman, you could be a doctor. I've got a lot of doctors on there, and we have some good conversations in the comments. But it's just making people smarter, and that's all that matters, is getting people smarter around us, and not get snowed and gaslighted by the government anymore, and understand what's going on around them and how money really does work. So.
Beautiful. We'll include all of your contact details and the information in the, of course, in the show notes. James, it's been an absolute pleasure. Thank you so very much for being on the show. Be well, my friend, and I might see you in. Will I see you in Miami?
I will be there. I'm supposed to be speaking, so I'll see you.
Fantastic. I'll be flying in from Melbourne just to see you.
Awesome. me and 25 other key friends. It's very good to be here. Thank you for having me, Carrie. I appreciate it. It was a pleasure.
All the best. Take care. Cheers.